What happens when panic becomes automated? When leverage executes itself? When contagion spreads at machine speed? For decades, financial crises were driven by humans, fear, greed, and mistakes. But the next crisis may not be human at all. AI is now deciding trades, predicting risk, reallocating capital, and executing orders faster than any regulator can blink. A system once built on emotion is being replaced by one built on automation. And the question isn't whether AI will reshape the financial world. It's whether the financial world can survive the version of AI it just created. Because once algorithms learn to panic faster than people, the entire system changes. AI didn't enter the financial system with a boom. It slipped in quietly, one algorithm at a time, first as a tool, then as an assistant, and now without anyone fully admitting it as the core operating system beneath global markets. For decades, finance ran on human limits, human judgment, human speed. Mistakes were slower, panic was slower, contagion was slower. The system could bend without snapping. AI changed the tempo. What began as simple automated trading became machine-driven risk engines, liquidity models, prediction systems, and fully autonomous execution loops. Banks now rely on AI to price assets in real time. Hedge funds let algorithms reshape portfolios without approval. Market makers use models that react thousands of times faster than a human ever could. And in calm markets, it feels like an upgrade. More efficiency, more liquidity, more precision. A system that seems smarter than the people who built it. But upgrades always come with hidden conditions. Because once AI becomes the foundation, the system inherits its nature. Speed becomes fragility. Precision becomes overreaction. Interconnection becomes vulnerability. And beneath the surface, something deeper is happening. AI models study the same data, imitate the same patterns, react to the same signals. They may look independent, yet behave like a single organism. That is the quiet tension forming beneath global finance. A world built for human decision-making, now powered by something humans can no longer fully predict or slow down. The open question is not how AI will improve the system. It's what happens the moment the system asks AI to make a decision at a speed the system cannot absorb. The setup begins here. Automation has taken over the wiring, and the consequences are no longer theoretical. AI in finance feels new, but the pattern beneath it is not. Every major financial shock in modern history reveals the same lesson. When markets become too automated, too interconnected, or too dependent on a single system of decision-making, the smallest spark travels farther than anyone expects. Begin with the program trading era of the late 1980s. Computers were supposed to bring stability and discipline. Instead, they amplified panic. When selling began, automated models sold more. Then more. Then more. What should have been a correction became free fall. Machines followed their rules with perfect obedience and zero hesitation, and the market collapsed faster than humans could react. Move forward to the rise of high-frequency trading. Microsecond algorithms battled for speed, reacting to signals no person could see. For most of the time, it created liquidity, until the day it did the opposite. A single anomaly triggered a chain of automated reactions that erased nearly $1 trillion in minutes. Humans watched the screen like passengers on a vehicle they no longer controlled. Then came the flash crashes, sudden, violent, inexplicable. Charts falling vertically, prices evaporating, liquidity disappearing faster than any manual trader could intervene. Regulators investigated, experts debated. Yet the conclusion was always the same. Automated systems reacted faster than the market could absorb, creating a loop that humans could not interrupt. 3 moments, 3 lessons, 3 warnings. The problem is not intelligence. The problem is alignment. Machines obey logic, not context. They react to signals, not consequences. They accelerate whatever direction the system is already moving. The uncomfortable truth emerges from every historical episode. Whenever automation becomes the dominant force in markets, volatility becomes unavoidable. Not because the machines are flawed, but because the system was never designed for decision makers that never hesitate. AI is not repeating history, it is scaling it. What program trading did in seconds, AI can now do across entire markets in fractions of a moment. The past reveals the mechanism. The modern world reveals how much larger the impact can become. AI has not replaced humans in finance. It has replaced the space between decisions, the pauses, the hesitation, the moments where instinct might slow something dangerous down. That delay is gone now. Algorithms compete to react faster than the next machine, and AI is becoming the brain behind those reactions. Today, a single market move can travel through thousands of AI models at once. They read the same signals, they draw the same conclusions, they execute the same trades, not because they copy each other, but because they are trained on the same data and optimized for the same outcomes. The result is a system drifting toward one collective mind without anyone noticing. Banks already use AI to monitor risk, price assets, approve lending, and detect anomalies. Hedge funds use AI to predict flows, position ahead of news, and exploit micro-patterns invisible to human traders. Corporations use AI to manage currency exposure and financial planning. Governments use AI to stabilize markets and detect stress. This sounds efficient. It is, until the signals turn negative. When stress appears, the same unified logic that creates stability becomes a force multiplier for fear. AI risk models tighten exposure across institutions at the same time. Automated trading systems offload assets together. Liquidity providers widen spreads to protect themselves. One downward move becomes a cascade, not through emotion, but through synchronized calculation. The numbers already reveal the shift. Volatility spikes appearing in markets that were once calm, tight correlations forming between assets that should move independently. Funding costs rising after tiny signals that should be irrelevant. These are early signs of a system becoming too uniform. The danger is not that AI miscalculates. The danger is that AI agrees with itself. When thousands of models converge on the same response, markets lose their shock absorbers. Diversity of judgment disappears, and the system behaves like a single organism moving in one direction. History warned what automation can do in fragments. AI can now do it across the entire architecture. The pattern is forming. The question is whether anyone can still interrupt it. Every financial system reaches a moment where pressure stops hiding in the numbers and begins reshaping the structure itself. AI is pushing the global system toward that moment faster than anyone expected. The first strain appears in liquidity. AI trading systems react in milliseconds, pulling orders the moment volatility rises. Markets that once relied on human patience now thin out instantly. A small shock becomes a sudden vacuum. Prices jump not because the move is large, but because AI removed the buyers before the market even realized what was happening. Then the pressure moves into leverage. AI-driven platforms optimize borrowing at speeds human risk officers cannot match. They expand positions when conditions look safe and unwind them the moment conditions shift. The result is a world where leverage grows quietly and then collapses instantly. No warning, no gradual adjustment, just acceleration upward and acceleration downward. Banks feel the next layer of strain. Automated risk engines tighten lending standards across entire sectors at the same moment. A pattern flagged in one corner of the market triggers restrictions everywhere else. A single signal becomes a system-wide freeze. Credit slows, funding dries, markets stiffen, and the pressure spreads far beyond the source. Corporations discover how quickly stability can vanish. AI-powered treasury systems cut currency exposure, unwind hedges, and pull liquidity from vulnerable regions at the first sign of instability. What once took days now takes seconds. A ripple inside one country becomes a shock across multiple continents. In this environment, the spark can be anything. A suspicious price move, a misclassified data point, a flawed model update inside a single institution. None of these events cause a crisis on their own. But with AI plugged into every major financial artery, each one becomes a potential ignition point. The system no longer waits for human fear. It reacts before humans even know there is something to fear. This is the real pressure point, not the technology itself, the synchronization it creates. A global financial system moving in one direction at the same time, because thousands of models are reading the same environment and choosing the same response. The world has seen contagion before, but never contagion at machine speed. When AI tightens the structure does not bend gradually. It bends instantly, and once it bends, it is almost impossible to stop. If the trajectory continues, the collision between artificial intelligence and the global financial system will not stay inside the markets where it begins. It will spread through every structure connected to money, risk, and trust. Because the modern economy is not built on human decisions alone. It is built on automated reactions that now operate faster than the world can absorb. The first fractures emerge in sovereign stability. Governments that once relied on predictable markets face AI-accelerated volatility. Their bond yields swing in seconds. Their refinancing costs spike without warning. A routine auction becomes a stress event. A single mispriced signal in an algorithmic model can trigger billions in outflows across borders that had nothing to do with the original shock. Banks feel the next wave of strain. AI-driven liquidity models tighten credit conditions in perfect synchronization. Lending slows, margins shrink, funding evaporates. A bank does not collapse in a cinematic moment. It weakens quietly through automated withdrawals, margin calls, and shrinking collateral values. Confidence erodes long before the balance sheet breaks. Corporations follow. Supply chains contract. Investment plans freeze. Hiring stops. A tightening of digital credit becomes a tightening of real life. What begins as an abstract algorithmic shift becomes a tangible economic slowdown. AI accelerates the downturn not because it is malicious, but because it is obedient. It follows signals, not judgment. Then the global layer moves. Currencies swing violently as automated trading systems chase safe havens. Commodity prices destabilize. Capital flees emerging markets at speeds no human regulator can counter. A world built on interconnected data streams discovers that synchronized machine logic can turn local stress into global contagion. But even now, the story is not only collapse, it is revelation. AI exposes which financial systems were truly resilient and which were fragile long before the world noticed. It reveals which countries built their foundations on real strength and which relied on liquidity and momentum. Crises powered by automation do not erase the system, they clarify it. The question is no longer whether AI will reshape finance. It is whether the world is prepared for a system that reacts faster than humans can respond. A system where panic, leverage, and contagion move at machine speed. The signals are here, the pattern is emerging, and the consequences will not wait for permission. If this gave you a new perspective, do not just scroll away, hit subscribe. This is Economic Chronicles, where history exposes the present and the future is written in the lessons we refuse to learn.